Greetings, everyone. My name is Kyle McLean, and I'm a partner and senior wealth manager here with Rhame and Gorrell Wealth Management. Today, we'll be covering one of the most potentially lucrative tax strategies within the Shell benefits infrastructure, the mega backdoor Roth. If you or someone you know could benefit from this strategy or the other services that our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. Without further ado, let's jump into today's topic, the Mega Roth. So, what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within the Shell Provident Fund. By undertaking a series of transactions, employees can make Roth contributions beyond normal IRS limits. For instance, in 2025, employees can contribute $23,500 either via pre-tax or Roth contributions, with a catch-up contribution of $7,500 available if you'll be 50 or older by the end of the year. The Mega Roth allows certain employees to add over $10,000 additional dollars beyond that to the plan annually. I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2025, employees can contribute $23,500 to the pre-tax or the Roth account, or some combination of the two. As we may know, pre-tax contributions are made before federal income taxes are paid. However, all of your contributions and your growth on those contributions are taxed upon withdrawal in retirement. Roth contributions, on the other hand, are made after federal income taxes are paid, and all of your future growth, as well as your original contributions, are tax-free upon distribution. The determination of whether an employee would want to make pre-tax or Roth contributions is entirely dependent upon their current tax rate versus their anticipated future tax rate. If you'd like a deeper analysis of this topic, please see our pre-tax versus Roth contributions video. Concurrently with your pre-tax or Roth contributions, the company will be making a 10% matching contribution into the pre-tax account. Based on the contributions discussed above, the total going into a 401k for an individual maximizing the pre-tax contribution and making $325,000 a year is $56,000 from a combination of the employees and Shell's contributions. This $56,000 total is well below the IRS maximum contribution limitation for all sources of contributions, which is $70,000 for those under the age of 50 and $77,500 for those over. So, where can this difference between the IRS limit and the other maximum contributions go? You guessed it, the after-tax account. While some plans allow you to make an after-tax contribution up to the IRS limit for total 401k contributions, the Provident Fund imposes a limitation of $11,500 for the 2025 tax year as a contribution cap to the after-tax account. Let's discuss the tax features of the after-tax account, because they're a bit of a blend of the tax features of pre-tax and Roth accounts. After-tax contributions, as the name implies, are made after federal taxes have been paid from the funds. However, growth that occurs while in the after-tax account is taxed as ordinary income upon distribution. So you might ask yourself, why would I contribute to an account with no current tax bill reduction, but all of my growth will eventually be taxed as ordinary income? This is because we don't intend to leave the funds in the after-tax account to grow indefinitely. The Shell Provident Fund allows participants to convert these after-tax funds to Roth within the plan. And the best part, if funds are converted to Roth before growth occurs, the conversion is entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into a third repository within the plan. This is called the after-tax account. Subsequently, the additional funds are converted into the Roth account, where you will enjoy tax-free growth until they're distributed in your retirement years. At this point, we hope it's becoming clear that the strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k plans outside of Shell do not offer this strategy. If you look at all eligible 401k plans in the US, only about 3 in 10 offer the Mega Roth. Let's consider a comparison of an individual who fully utilized the Mega Roth strategy over the course of their career within the Roth account versus an individual who alternatively diverts these funds into a brokerage account. Given that the Roth earnings are tax-free, while the brokerage account earnings will generally be subject to a 15 to 20% tax rate on long-term capital gains and an ordinary income rate of up to 37% on interest income or short-term capital gains, the differential is, at minimum, several $100,000 of needless taxes paid. Before we wrap up our conversation today, I'd like to draw your attention to a few important considerations surrounding the Mega Backdoor Roth. If you have a pre-existing after-tax balance within the Shell Provident Fund or growth on recent contributions, you should be aware of the Pro-Rata Rule. The Pro-Rata Rule states that if an after-tax account contains a mix of contributions and taxable earnings on those contributions, any conversion or distribution from that account will be partially taxable depending on the ratio of these contributions and the earnings. These numbers are different for everyone, so we highly recommend that you discuss the effect of any current after-tax balance that you have with a tax expert, such as our in-house CPA professionals who can help you understand the tax implications of any future conversions. In some cases, it can make sense to execute a partial pro-rata rollover distribution of your after-tax contributions and earnings to your IRAs outside of the Provident Fund in order to tax optimize future in-plan conversions. Again, these transactions are complex, so you want to ensure that you have a tax specialist on your side when making conversion or rollover decisions. Thanks again for spending some time with us today to learn about the Mega Roth strategy. At Rhame & Gorrell Wealth Management, we provide advice on over $1 billion in client portfolios. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. The many CFP and CPA tax professionals on our staff specialize in helping our clients take advantage of advanced financial strategies to materially enhance their financial ability to enjoy their lives both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.